Okay, so everyone, we've been talking about building an equity portfolio. Well, one of the things that, quite honestly, you better be considering as a portfolio manager, you need to think about risk. And you see I've got a couple of things already written in here just so we can really key in on the focus. There are no free lunches in the market. If you want a higher expected return, you're going to have to take a higher risk. So what I want you to think about this concept of risk management. My first part of the career, I really focused on the top part of the Sharpe ratio. This is alpha, your return of the portfolio over this risk-free or benchmark, whatever it is that you were using. I spent most of my career chasing alpha. The last 5 years of my career, I changed. I started to focus on risk. And I can tell you the academic research that I'm doing right now is incorporating environmental social factors into giving us a better understanding of risk. Does these ESG factors help us understand risk better? From an academic standpoint, it's unclear. Some studies show it does, some show it doesn't. I'm working on that, trying to verify what are the important metrics that help impact that risk. So keep your eyes out in a couple years. Hopefully some good papers will come from this. So here's what I want you to think about. There are going to be things that you do to the portfolio that are going to contribute to the risk of the portfolio. And what I want you to think about, and this is normally easier up front than in the back, but you need to think about a risk budget. How much risk are you going to appropriate? How much risk are you going to give each position? I can remember before the financial crisis, there were some firms that I knew very well that had very high weightings of Freddie Mac and Fannie Mae in their portfolios. So they kept increasing their risk budget more and more and more. And unfortunately, when those companies were taken over, the stock price was crushed, those portfolio managers were crushed. So I want you to think about a proper risk budget, and more importantly, you got to follow it. When you look at long-term capital management and most of the main failures on Wall Street, it wasn't that their strategies were poor or these Nobel laureates, they didn't know what they were doing. They did. What happened was the risk budget. And here's what I want you to think about. When we get to derivatives and use things to actually mitigate these risks, risk is expensive. Mitigating risk is expensive. Every year, I had to buy fire insurance in Southern California. Now, I couldn't get mad at the end of the year and go, you know what? My house didn't burn down, so that was a terrible decision. Or car insurance. You know what? I wasn't in any accidents this month. I'm so angry because I paid all this money. Well, risk and allocating risk budget, you will lose returns sometimes. There are going to be times you would have been better off not using that, mitigating that risk. And what I want you to think about, though, is you have to take some risk. Always remember, a portfolio with no risk earns the risk-free rate. So you're looking at right now, at the time of this recording, you're lucky to get 3% on a 10-year treasury. So if you eliminate all the risk in your portfolio, you basically have just locked in a 3% return on your portfolio, and I don't know any fund managers that can survive by just earning the risk-free rate of return. So let's talk about this idea of risk. Where does it come from? So one of the things that I want you to think about, absolute risk focus on something to do without reference to a benchmark. One of the ways that I saw this in the alternative investment space, specifically hedge funds, their goal was to earn the T-bill, plus 2%. So whatever the T-bill is, they wanted to earn 2% of that. So we can actually look at the contribution of this asset through the portfolio variance. Again, another one of the few formulas in this section, but it's more just to help you understand where is this risk coming from? How much is this asset contributing to the total risk of the portfolio. And remember, in finance, we're going to really focus on portfolio variance, but variance isn't really helpful to us. We really have to focus on the standard deviation of that variance. So ultimately standardizing that variance, then we have a better idea and we can build into confidence intervals and understand how this impacts our portfolio. So again, how about contribution from factors? Remember those drivers of performance. Well, we can also contribute this risk and attribute it to various factor exposures and maybe even some unexplained factors that we didn't think about. So again, another one of the few formulas. So what I want you to think about, and this is the key, as long as our variance and we identify the risks that are important, we shouldn't have very high unexplained variance. But if that unexplained variance is really high, that means there's something going on in this portfolio isn't the way that I wanted it to be. So your work is to figure out, why is there so much risk? I thought I identified all the factors that mattered. You must have missed something. Or maybe the relationship that you looked on historically is not carrying forward in the future. Okay, now let's talk about, we talked about absolute risk. Absolute is the risk that's generated not compared to some benchmark. So relative risk says, okay, I want to go through the same experiment again, but this time I want it to compare to some market index, to some benchmark. So we're going through the same question again. What is the contribution of this asset to the portfolio's active variance? So what I want you to think about, and we know this already, assets contribute more if there's higher active weight, so you're different than the benchmark, and guess what? Your active returns are going to be related to the overall portfolio active returns. So what do we mean by this? If I focus on this factor and I overweight it, it is going to relate to the returns that I get in this portfolio. So again, we're still just trying to figure out, hey, in regard to the overall portfolio, the overall active variance of this portfolio, how much did this contribution of this asset contribute compared to its benchmark? So let's talk about risk level considerations. Now, when we get into the risk management section and enterprise risk management, this is where we really get to the heart of it from a corporate standpoint. But the reality is most fund managers do not use enterprise risk management to focus on portfolios. So what we're doing right now is extremely critical and important in assessing the risk level. And more importantly, how much risk level am I willing to accept? So implementation constraints. Guess what? There are some things that we can do. Maybe we use derivatives. There are going to be some limitations. Maybe this derivative has basis risk. It's not very closely related to the risk that I'm trying to isolate. Or the other thing that I want you to think about, the more we target this factor, the more we actually reduce diversification. I'm all for concentrated positions, but if we're wrong, we better accept that we could be horribly wrong when it comes to our performance. And then leverage. Too much leverage, hey, if I'm right, I don't care, this is wonderful. But leverage, just like in cars, too much leverage is bad, especially when something bad happens, just like speed. You know, we want cars that are really fast. Well, if you're driving too fast and you get in a car accident, there's a danger with that speed, just like the speed of your portfolio. If your client wants to drive down the highway at 55 miles an hour, why did you design a portfolio that's more suitable for a racing car going 200 miles an hour down the freeway? So how you're going to implement this, the difficulties you're going to have implementing it, the diversification and the lack of diversification that you're creating and the leverage are all going to impact your ultimate returns. So this would not be complete if we didn't talk about heuristic risk constraints. So guess what? You really think about it, one of the things that I was told from very little, don't put all your eggs in one basket. It's interesting. So we proved this financially, back in the 1950s with modern portfolio theory, but it is amazing to me how many people still continue to do this. So these heuristics, don't put all your eggs in one basket. Understand what you're investing in. Don't take too much leverage. Don't over-concentrate your portfolio. Don't be too much invested in stocks. There's some wisdom in these things. So these heuristic risk constraints, sometimes they seem to actually work better than the quantitative risk constraints that we're creating. So let's talk about formal risk constraints. So let's face it here. If we're going to use statistics to predict, that means we're going to have to do some forecasting. And this is where the problems come into play. Again, I was much better looking backwards than I was looking forwards. So we have to think about how are we going to quantify, because first of all, we have to identify the risk. And we can't just say this is more risky, this is very risky. I want to know how risky this is and how does it compare to something else. So I want you to think about, we've got some issues when we're dealing with risk. A lot of constraints. Active risk. How different is your portfolio? Hey, is your distribution skewed? What about drawdowns? And when we actually get to the risk management section, value at risk. So guess what? It turns out, hey, if 95% of the chance of the time we don't have to keep more than $2 million a day on hand, and we're comfortable with that. The problem is what happened in that left tail. So again, in a normal distribution, we're worried about VAR over here. This 5%. This is what we forgot about in the financial crisis. So what's all the academic research focusing on now? They're focusing on conditional VAR. So if this 5% does happen, how bad is it going to hit us? Are we going to be able to survive? It's not enough to just say 95% of the time here, everything's good. We've got to zero in on this left tail risk. And same thing with marginal VAR, incremental VAR. All of these things continue to get added into the industry so we can do a better job of identifying risk. We thought VAR was the standard. It's still used in a lot of companies. It's still used by federal regulators. But the question is, does it do a good enough job of identifying risk? And then some more additional risk constraints that I want to end with. So leverage, we talk about this. Everybody loves leverage. It can juice up your returns. But the problem is it can actually destroy your returns just as easily. The other thing I want to caution you on, unexpected increases in volatility. This is going to become really important with options. When we get into derivatives, volatility is going to be a big driver of options. The next thing you need to understand is that there's going to be risk measures that are more appropriate with your management style. For instance, I'm tired of hedge fund managers continuing to talk about Sharpe ratio. A Sharpe ratio is great if the distribution is normally distributed. But if it's not, stop using the wrong risk measure to measure dangers in the portfolio. Same thing that you've got to think about also, because of concentrated positions, you're going to have more difficulty with statistics just because you've got smaller portfolios. There's less sampling data, there's less data. When there's less data, our forecasts might become suspect, or at least not as comfortable with them going forward. So again, just to summarize this whole chapter, expected return is one side of the coin. The other half is risk. If you want higher expected return, you're going to get more risk. But what we're saying is don't just take risk for granted. Figure out ways to take the risk that you want and give away the risk that you don't want. That's what we're going to focus in on derivatives.